This is Ubaid on behalf of V Electronics, and in this video, we're going to talk about government regulation and the Great Depression. So, government regulation and the Great Depression. Now, when it comes to the Great Depression, okay, what's going to end up happening is, okay, if the government makes mistakes, for example, and as the history books mention, they do make mistakes time in and time out. Okay, it's going to lead the economy into either a recession or what we know as depression, the Great Depression. Okay, now when it comes to the stock market crash of 1929, okay, they do say in history books that government made mistakes. Okay, now mistake number one was that the government allowed the stock prices to go up too high. Okay, so the government, this is mistake number one. Okay, stock prices were too high. So the Dow Jones Index went up to 300, 350, and by 1929 it crashed. As a result of which, what ended up happening was the stock investors they started withdrawing their money and they had to sell low. Okay, which meant they weren't making that much profit. Okay, what ended up happening was okay, you have um, a market crash. All right. Now, on top of that, you have banks. Okay, banks who invested in stocks. Okay, they were losing money as well, as a result of which depositors who deposited their money in the banks, okay, who didn't expect the banks to go bankrupt, eventually started withdrawing their money. Okay, saying, hey, listen, if these banks go bankrupt, we're going to lose our money. As a result of which, okay, they started withdrawing their money. And this eventually, okay, started the Great Depression of 1929. All right, so that was mistake number one. Okay, mistake number two, okay, has to do with the interest rates. Now, the Federal Reserve, okay, they raised their interest rates. Okay, Federal Reserve, they raised their interest rates. Okay, Federal Reserve raised their interest rates. And because these interest rates went up, okay, what ended up happening was, okay, let's say they went up from 5 to 6%. Okay, business investments in asset went down. All right, because obviously when the interest rates go up, people start investing, people start saving money rather than spending money. Okay, and because these interest rates go up, okay, the GDP eventually goes down. Okay, business investments go down, consumer spending goes down. Okay, so on and so forth. Okay, so this was another reason for the crash in 1929 and the Great Depression. Now, apart from that, you also have the banking policy. Okay, so mistake number three, as the history books write, okay, you have an issue with the banking policy. Now, back in those days, you had thousands of different units spread across the country, as a result of which, if one bank or one depositor, okay, with a lot of money in the bank, decided to withdraw his or her money, the banks eventually would fail. Okay, because when you have few reserves and a lot of money lent when it comes to mortgages and loans, and you don't have too much money in terms of the money deposited by the depositors, then you're going to end up okay with no money to pay back the depositors who will need their money back on demand. Okay, so this has to do with banking policy. So unlike today, where we have a lot of banks with several branches spread across the country, back in those days, especially in the US, for example, you had thousands of small banks across the country, and these banks, okay, they didn't have any branches, okay, which means they were basically like a retail store, okay. If the reserves went low, Okay, the retail store wouldn't be able to supply or return the money deposited by the depositors. And because they weren't able to return the money deposited by the depositors, they eventually ended up losing money. Okay, they ended up losing their business. All right, so that was the idea. So banking policy. Okay, so rather than one bank, okay, one bank with several branches. Okay, you have thousands of different units spread across the country. All right, and eventually this was the cause of the Great Depression. Okay, the collapse of the banks because there was a big gap between customer deposits and the loans and the mortgages that were given out. All right, as a result of which banks didn't have enough money to return, okay, to the people who deposited money in their banks. All right, now apart from that, you also have tariffs, and this was mistake number four. Now, when it comes to tariffs, okay, what's going to happen is if you have a lot of money, okay, if you have a lot of money, um, or let's say when the governments they raise the tariffs up high, okay, when the tariffs are too high, okay, what's going to end up happening is, okay, there's going to be um, okay, a restriction of trade. Okay, people are going to trade less. Countries who are involved in trading, they're going to end up losing money, okay, because obviously there's not a lot of imports because the countries who are trading, okay, they've stopped trading with these countries with high tariffs. Okay, so mistake number four was tariffs. All right, so that will be it for this video. On behalf of V Electronics, this is Obey. Have yourself a great day.